All right, so we are diving into training here today. So last week we kind of kicked off talking about permanent life insurance. And so where I left things off is I wanted to start training today and kind of spend time talking about like an illustration, some of the ins and outs of permanent life insurance, how they grow, how they earn value and interest inside the account. But I wanted to recap with you guys. So tell me some things that you remember from last week or some questions that you have still about permanent life insurance. Anybody?
I guess I wasn't here for it, but could you give a small little summary of it?
Yeah, absolutely. Permanent life insurance is not term insurance. I'm just messing with you. So, so one of the easiest things that I had covered. So, term life insurance, Ryan had covered on training a few weeks ago. Term is using the word if. So, a term is going to cover a set period of time if I pass away in this time frame. Permanent life insurance is permanent. So it's when you know that this is going to pay out. So typically there's going to be a larger amount of premium that goes in relative to the death benefit. So $200,000 of term life insurance might be $20 a month, but 200,000 of permanent life insurance you might be putting in $200 a month. And the reason is not that it's more expensive, it's because there's going to be additional cost. But part of that and the majority of what you're then putting into a permanent life insurance policy is going to go towards the cash value, which is your internal personal money that you can now track inside of a policy. It's an additional account that's growing and accumulating interest on your behalf. So that was something we had talked about. Why to use permanent life insurance? There's a number of scenarios, but something that we had kind of spent time talking about last week is we're probably all doing a lot of term insurance right now. And as a team and as kind of a philosophy, we should probably be adopting and resonating with where does permanent life insurance really add into the mix long term for the various people that we sit down with. So, for example, last night I sat down with a young married couple. They just had a child here. They're in their late 20s, and they, no questions asked, super ready to get $1 million of life insurance. But the wife, this is a couple I've been working with for 6+ years now. She is like adamantly against permanent life insurance. So in this case, I mean, I've spent 6 years nurturing the relationship, and she has only gotten less and less interested in it. But the point being, and why I'm bringing them up, is they're in their late 20s. So 30 years from now, after a term policy is up, they're still only in their late 50s. So is there a potential play where we could say, hey, if you want $1 million of life insurance, maybe we get 800,000 of term, but in 30 years that's gone. So if we get a portion of what you're wanting in permanent coverage, we now still have something then thereafter. Because in 30 years, even if you have the best health rating possible, getting an additional amount for a couple years is going to be significantly more expensive than it is today. So how do we go about kind of managing those two things? Does the client have an affinity for terms? I have some clients, they've said, I think term insurance is a scam, so I want permanent life insurance. And I've had, on both sides of the aisle. But how can we as agents and representatives represent the strategies we work with and then our clients at the same time simultaneously? So in a lot of cases, there's a chance and a reason for us to utilize permanent life insurance. And I'll save kind of the conversation for where that would be a fit. That was something we had talked about, and that's on the recording. But how we then implement permanent life insurance and how do we then earn value inside these, that's what I wanted to spend some time talking about today. So, that's kind of a quick 5 minute recap on what we had talked about last week. So kind of diving in and kind of taking a step forward here. I had said there was kind of two major types of permanent life insurance. So there's whole life and then there's universal life. So whole life, the big distinction, the big factor there on whole life insurance is going to be the cash value inside that policy is going to earn a fixed rate of return or a declared rate. So, an XYZ company is going to say, hey, we will pay you 3%. So that's going to never really change or fluctuate. If the market's up 30%, if they're down 30%. So there's going to be times where the rate of return you get in a whole life policy is going to significantly underperform all of your other assets. But sometimes it might be a safeguard. So there's pros and cons to how that grows in interest. But then universal life, the big thing there is one, flexibility of premium. So maybe we're putting in $200 a month now, but we have a couple things we need to pay off, and in 6 months we can make it up to 300, or we have something come up where we need to stop making premium payments for 90 days. We have the flexibility there where there's not flexibility inside whole life. But then the second thing is then how it's accruing interest inside the policy. And that's what I was going to show today. There's indexed universal life and then there's variable universal life. So indexed universal life, think of kind of having bumper guards when you go bowling. So there's going to be a cap and a floor strategy. So on the floor, maybe it's 0%. So the market goes to haywire. You're contractually guaranteed that you won't lose any money inside the market. So that's really valuable for clients that we have that say, hey, I'm maybe a little concerned about the market. I want to have something that's a little more protected, not too risky, but I still want to earn interest when the market does go up. So there's a cap, call it 12 to 15%. The market's up 10, you get 10, the market's up 25, maybe you only get 15, but it gives them the flexibility and peace of mind to know, hey, I'm never going to lose anything, but in most cases, I'm going to still net a positive return every year. But many of my clients and most young people say, hey, I'm willing to take risks. I'm not really concerned. I don't need this money anytime soon. So a variable universal life policy will get invested just like managed accounts, just like anything else we do, where it'll go up and down and fluctuate on a daily basis inside the stock market. But both cases, you have this cash value bucket that you have the ability to access at certain periods of time for the betterment of what you want to access that for. So some clients, they use it for a midterm bucket. So yesterday I met with a doctor. We were talking about it off the recording. He's got a lot of money sitting in short-term buckets. He's got a lot of money in long-term buckets, but he doesn't really have anything in the middle. So we've got significant money already growing at a very fast rate for retirement, but that's 30 years from now. And we've got significant money set aside in bank accounts and high yield savings accounts and taxable accounts for the today. But what if he wants to not only put money in, but take money out somewhere in the next 10 to 15 years? And that's where a permanent life insurance policy can come in. So I'm going to share my screen here and I put together an illustration. The hypothetical person, I think I just did like 250,000 of life insurance, putting in like 200, 250 a month, but I want to show apples to apples, the same numbers going in and how they compare and contrast coming out. All right, so do you guys see my screen here now? I'm going to take that as a yes. So both of these are with Nationwide Insurance. So on the indexed universal life side, we have a multitude of people that we have access to. On the variable universal life side, there's a couple companies that we would be able to work with. Ultimately, the flagship carrier is Nationwide, so it's easiest to just show the both illustrations from the exact same company so you can see these parameters. So I'm going to flip through the illustration. You can see it's 44 pages, so it is a lot to walk through. We have some previous trainings where I think Ryan and Joe walked through illustrations live as though they were talking to a prospective client presenting to them. I want to save some of those details to go back and watch those videos, but there's a couple key highlights that maybe I want to show just to give evidence of how these grow and accrue interest. So on the indexed universal life side, there's a number of indexed strategies that we can participate in. Typically, you're going to do what's called a point to point or 1 year time frame. And the one that I would spend time on here, just here at the top, this 1 year S&P 500 PTP, meaning point to point. So January 1st to January 1st, what's the stock market do during that time? And then that's where we have a cap and a floor strategy. So you can see the cap rate is 10.5%. So this number here has the ability to go up and down. So Nationwide can say, hey, we're in a position where actually interest rates went down, so now we need to lower this, or maybe interest rates go up and now they can give you a higher cap. But then the floor is 0%, and that's also guaranteed. So we can show someone if we picked this strategy, they will not lose anything. They can get up to 10.5% on an annual basis. But what's happening is while this takes place, this money is sitting in what's called the general account of the insurance company. They're just sitting in government reserves, accruing a little bit of interest, but all this is doing is tracking the S&P 500 during that time. So similar to some other products that we have talked about, that money is set aside and it's just generally following this index. So it keeps it simple. It's easy to follow, easy to maintain and manage over time. But that's how we're ultimately then going to get interest credited to the account. So because this isn't actually invested into the stock market, we're not earning dividends like we would in maybe a Roth IRA or your 401k or things like that. But this is set aside and we will get credited interest during that time frame. So for new people, I want to pause here. Does that all make sense to you? How an index universal life policy would accrue interest inside the policy cash value? Thumbs up. Yes. Head nod. All right. So we're going to dive in. There's a lot of other things to factor in and talk about if we need to take a loan. How does that work? A lot of things that really isn't worth our time here today because I want to spend on how these compare and contrast. So, an illustration when we work with a company, they're going to have a number of scenarios. So, when you're getting ready to present to a client, the funniest but most serious thing you need to do is make sure you're showing them the right illustration. So like in this case, this is showing a 0% return. How would our clients like to see this? No, right? Obviously not. So we want to flip down and we want to make sure we're tracking. Here's where we're looking to be at. So Nationwide is showing an illustrated non-guaranteed rate of 6.59% per year. So this is what we would want to show the client. So how we're going to be tracking this, there's a couple things to notate here, but what I want to do is highlight kind of the first 10 years, and then we'll go to about 20 and then 30 years. So any company that we do on the permanent side, they're going to front load their costs inside the policy. So these investment policies are not get rich quick. So the person I talked to yesterday, he said, if I put a bunch of money into this, I can get every penny out in 3 years, right? That's not how this works. So permanent life insurance contracts are a long-term commitment. And so because of that, these insurance carriers, they front load how much they're going to charge on the front end. So on the back end, after that kind of initial time frame, you have more of your money earning interest over time. So in Nationwide's case, they're going to front load as much as they can in the first 10 years of the policy. And then starting in years 11 through the remainder of the policy, a lot less costs are associated. More of your money is flexible and more of your money is now earning interest. So to demonstrate that this accumulated value column and this net surrender value column are different numbers until we reach policy year 11. At that point, you can see they're both $40,007. But beyond that point, that's where if someone says, hey, I need to take some money out to buy my kid their first car, or we need to send them to college, or I want to put a down payment on a new house, or I want to buy a business, or I want to take my family on a vacation, whatever it might be, we now have a lot more flexibility to borrow or withdraw from the account here. And we have some more flexibility. This is an additional account that we'd have access to. But how this is working, remember, is a 0% floor and a 10.5% gain on the high end. So the interest, is assuming 6.5% per year. So we're going to be limited on how much we can actually earn over time. So in 20 years, a client has put in $72,000 and they have 107,000. So if they were to walk away, in this case, they have about $35,000 that they have accumulated in interest and growth on their account. So that's great. But then I want to dive further in. So I had mentioned, what do we do kind of at the finish line? So for some clients, we use this. Maybe they make too much money, they can't contribute to a Roth IRA. So we might use this as a wealthy man's Roth IRA or an additional income bucket long term. So in this case, what that means is we get to the kind of later years of their life, once they hit retirement age, we can now pull money from the cash value, and they do not owe technically any taxes on this money. So just like a Roth IRA, we've put money in, it's grown in value, and we can take that money out. We have access to it a lot sooner. It doesn't have that requirement of 59 and a half. But we have the ability, if we say we want to wait, we can now utilize this money later on in life, and now use this as an income stream. Uh, I didn't create that in here. I didn't want to put too much all in one policy, but what I wanted to show is this is how that's going to earn interest. And then I want to now compare this to a permanent policy. So I want to pause there. Any questions, thoughts, comments about Index Universal Life? Anything that maybe I've missed out on explaining or something that we should touch on? No. All right. I guess I'm doing that good of a job here today. So all right, so we're going to flip over to then the variable universal life. So, like I had said, variable universal life, now we can pick funds that we can invest into, just like we would our other managed accounts that we work with. And so, Nationwide as a company is one of the largest 401k carriers out in the financial world. And so, they provide their 401k fund lineup to these variable universal life policies for clients. So we have a huge range of investments that we can pick from. But the big thing that we're trying to delineate, one is what we need to, when you're sitting down with a client, is what's their risk tolerance? Are they willing to take risk in the market, or do they want to be more conservative? Something else, you have to have your insurance license to do an IUL, but you have to have your insurance and securities license to do a variable universal life. So in my personal story, I got my investment licenses pretty early on, but maybe you've been around here for a little while, or maybe you just currently only have your life insurance license. You would not be able to represent this product to clients until after you get your investment licenses. So that's a big thing to consider. Again, even more reason why to go and get those licenses as quick as possible. But from there, I'm gonna flip down here real quick just to show you guys the investments that we can work with in here. So, like I had said, we have access to a number of different strategies and all that stuff. So, when you come in, you can create a portfolio for a client just like we do anywhere else. My personal opinion, I keep it simple. This is not something I want to manage on a day-to-day or month-by-month basis. So, I try to pick some things that are relatively, easy to manage, easy to follow. We're not trying to do anything fancy, and clients typically like that. They, hey, then the Roth account or my traditional IRA or my taxable accounts, that's where we're going to try and do some fancy stuff. But here, let's keep it simple. Let's broadly track the market, what's going to do well over time, and just kind of keep it simple. But we've got two full pages of investments that we can pick from, which is great. But we have the ability to then reallocate that at any point in time. So I want to come in here then, like I had said, and show you guys what does it look like, and we can compare this back to the IUL, how these are performing short term and long term. So initially, you can see this is illustrating at a 7.41% interest rate assumed over time. So quick game of math, if 7.41% is bigger than 6.59, do you guys think that this is going to illustrate to look better or worse than the IUL?
Better, probably.
Yeah, why do you think that is?
It's a higher rate of return.
Yeah, yeah, pretty simple. Now, is that necessarily the answer? We'll find out. But the big thing that I wanted to kind of tee that up, one, to make sure you guys weren't sleeping, but two, there's different costs with different policies. So it's not going to be the same, it's an apple and an orange. So these are really similar, but there's going to be different costs associated. So they might be very close. So whenever I'm doing this for a client, I might have a client that's maybe 45 years old. I'm going to still run an illustration for either just to see how are the costs associated with these types of accounts. It might make sense to do one over the other simply for the fact that the cost will be lower in one over the other. But that's where we ultimately find that out, and we have access to do either of them. So again, going back into this, um, 10 years in after or in the 11th year, we have access to the full amount. Someone says, hey, I want to pull all my money out. We can do that. You can see this is, I think, within $17 of the other illustration, or $300, excuse me. So we're super close. So we're within $300. So are they the same? No. Are they very close in a short-term time frame? Yes, roughly. And then after 20 years, this has 115,000. And then we'll come over here after 20 years. That has 107. So now there's starting to become a gap. So this is where we say, how long is our time horizon? What are we ultimately trying to achieve? So how do these compare and contrast short, mid, and long term? But then if we compare, let's look 40 years out. So after 40 years, our client in this scenario is 75 years old. So they're probably now taking money from this policy. And in the IUL, they've accumulated 435,000. And after that same time frame, we have 570,000. That's a huge differentiation over that time frame. So, what do you guys think causes that difference? Bueller.
Both these policies are receiving the conditional credit endorsement, correct?
They should be, so we can check that. So Ryan, do you want to explain that here real quick?
Yeah, so it's calculated amount in that section that you breezed over in the beginning. It's a it's basically an amount that's calculated off of the amount being managed. So yeah, here in the VUL starts after 15 years, and I think the IUL is the exact same.
Yep.
So
Yeah,
those
so
amount
the
those
conditional credit endorsement, so yeah, it starts in the actually 11th year. So
11th
actually,
year on the IUL.
the way I explain this to clients is Nationwide as a company, if we build these correctly, they'll give an extra incentive to the client. If there's a reputable amount of cash value inside the policy, uh, anywhere from 10 to 15 years in, they will give you this credit endorsement to say, hey, kind of as a thank you for making sure that you're building this correctly. So if I remember correctly, it's a 40 basis point credit on the previous end of year cash value. So without getting too lost in the weeds, I'm gonna flip over here. So starting in year 16 for a VUL, 40 basis points of this previous end of year is essentially what that would come out to be. And that's how we can then start to, articulate how we're earning this extra interest inside the policy. So that's a factor, but both will play a role in that, and it's even more intriguing that an IUL will start that earlier. But I think what I was going to get at is I would argue that the costs associated with an IUL on the front end are probably going to be short-term and long-term more expensive. So I would argue the costs inside of VUL are going to be cheaper long-term. So the cost, if there's a lower cost to drag and a higher ability to earn interest, that's going to start to cause that separation over a longer time frame. So um, I want to I want to pause here. Is there any questions or anything about what we've covered? Is there anything that maybe we haven't talked about yet that we should bring up? Going once, going twice. I'm going to stop sharing my screen here. So ultimately, these are not the same thing. So if no one has anything else to add, then the only thing I would say is one, if you don't have the license to represent a VUL strategy, go and get those licenses. Um, and then Tony, I see your question here. The license is needed. I believe to do a VUL, Tyson, you can correct me on this. Is it the Series 63 will allow for you to be able to do this?
6.
6 and 63.
Okay, 6 and 63. So you'll need to get both of those. So then the SIE 6 and 63 before you'll be able to represent this.
Is that a change? I thought it
Isn't
was
the
just a 6 for
63
all.
just out of state though?
Yeah, I think in Ohio, I think they've changed that for new people. I think you have to have your 6 and 63 now in Ohio.
Hmm.
I'm pretty sure about that. But there was a time when that was correct, Joe.
Tony, Logan, just get all your licenses.
Don't even study, just pass the test.
How's your studying going, Tony?
I mean, it's going. I hit the halfway point on my SIE exam yesterday, so they
Awesome.
give you like a 75 question test to see. They call it checkpoint, and I got a 76, which you need a 70, so I'm on track. But it's it's a pretty rough
And that's a
slog.
big deal. I don't. You'll be our first one to go through this new setup, but like I feel like the biggest bump might or hump to get over might be that SIE because then you just have these top off exams that I assume
Yeah,
are a
they're
little
saying. I mean,
short.
I looked into it a little bit. The 663 and 65 apparently have some redundancy. So once you've learned it on the SIE, there's some stuff comes back, but I won't know until I get through this one. But it's a grind. I mean, it's a big, it's a 300-page textbook.
It's a license that pays a lot of money. That's the good news. What you get on the back.
That's my hope.
Yeah.
Do they still require a proctored location for the SIE, or can you do it like at home with like a camera and disclosures and all that?
I think I have to go on site, but I haven't finished the coursework yet, so I don't actually know
Okay.
that. My life insurance, I had to go on site, and I think I have to. I think I'll have to schedule somewhere, like that one in Maumee or something.
What Alan covered here today in terms of this training? Alec, I think you did a great job covering that. I have a sense that we probably aren't utilizing the IUL/VUL enough in our business. I don't think it should be our like core product that like everybody gets, as other teams are doing, but I also think it should be more than like a once a quarter transaction across our whole team. So we might. I know we've been super focused on FMAX and rightfully so. And in recent times, some of us have had to really focus on getting some accounts moved off of Betterment and all that. But don't lose sight of the track that along the way I've built a lot of policies, and these things are performing well. I mean, my VUL, I still have my original VUL from 2001. And I mean, it's got a bunch of money in it. I added pretty good amount of money on a yearly basis, but I've had years where I never added money, based on just not being able to, frankly. And the versatility has provided me financially, has been awesome. The permanent protection is always there. My cost of insurance is shockingly inexpensive. It's just a great product when designed the right way for the right client. And I just think we need to be open to like maybe some more case design where if a client has an overall need of $800,000 of coverage, maybe there's a path for part of that to be permanent and part of that to be term. Term always sounds great on the front end, right? It's super cheap. We check that box. We get the coverage in place. But, those things, I've been around long enough to have many term policies reach their maturity dates and just sunset, and you're quite literally renting your coverage. So, it's not sometimes we got to look at things in the big picture, and yeah, a permanent policy is going to cost more money, but I do think that's a pretty integral part of financial planning. And especially when you've got potentially some living benefits connected there, I think that adds some additional value. And, I love our balance. I love how we're helping people accumulate money and manage assets and grow investments. And I'm a stock market guy, but I've sure done a whole lot of life insurance, and, I've delivered some of those death claims, and it's a very important part of overall financial planning that I don't want to lose track of. Well, thanks, Alec. Great job covering that. We will work on a training for next Wednesday. Alec will be out of town, so I'll probably run that. Might reach out to some of you guys for some ideas in the meantime. But hope everybody has a good 4th of July holiday, and let's keep up our momentum.
See you guys.